This is the last topic for the exam, and that's going to be intangible assets. So don't forget, the exam will cover 5, 6, 8, and 9, and 9 covers intangibles. So an intangible asset, as we said, is an asset without physical substance, but has value because of the rights that they confer on the holder. So the first question is whether or not the impairment of an intangible asset would oops, sorry. See if I can get this down. Hold on. I don't see the volume. Oh, I'll just work on this one. Is it better? Yeah, I think. All right. So an intangible asset, the first dead spot there. I'll work it from here. Okay, so again, I want to know if an impairment of intangible asset occurs when the book value of the asset is less than its fair value. And then we'll go, after we do this question, we'll start thinking about reviewing a little bit on the intangibles, and then we'll move ahead. Okay, see if this will work. You got to read this one carefully because it's going to see if you understand the cost principle of this cost concept. Okay. Ooh. Here we go. All right. Now, I always tell you this. Listen, accounting's really easy if you put it into day-to-day terms. You own an asset. You have a car. And if the fair value of the car is more than its book value, if the fair value is more than its book value, or the book value is less than its fair value, you got a gain, right? If the fair value is higher, you have a gain. So in this case, there's a loss in the sense that the fair value has to be less than the book value, okay? It can't be the other way around. So if the fair value is less than your book value, that's when you have a loss. This question said when the book value was less than fair value. Book value less than fair value, okay, will be a loss. Okay, let's go to the next one. I want to know if you know what goodwill is. So what is goodwill? All right, very good. So everyone knows what that is. Okay. So goodwill represents the excess of what you will pay over the fair value of the net assets that you acquire in a merger and acquisition. Now, at the end of class on Friday, someone asked me, could there be negative goodwill? Could you actually get a company at a bargain? And the answer is yes. Whoever buys BlackBerry will probably get them at a bargain. We talked about Lehman Brothers. When Lehman Brothers sold, companies were buying, or the buyer of Lehman, or in my case, I worked with Bear Stearns. When Bear Stearns went under, they sold, or the building that Citigroup bought, they bought that building for less than its fair value. They had negative goodwill. Negative goodwill is something you don't really see in an intro class. That goes right into income, but this is positive goodwill. Let me go back and just review this. I mean, this was pretty good. I guess I don't have to do it. You seem to be pretty clear with this, but just to be sure, it was at the end of Friday's class, which is typically chaos. So just to be sure, if you didn't pick that up, it's here. Basically, what happens is that if you paid $800,000 for a company who has their assets minus liabilities appraised for $600,000, the goodwill is the excess over the fair value of the net assets acquired. What are they buying, by the way? What goes into goodwill? What are the factors? Now, that's how you calculate goodwill, and that's how it's defined. What are some of the factors in what do you know, again, we rule out stupidity. You're not going to pay more for a company. You do make mistakes in practice, I guess businesses do, but we're assuming it's a rational purchase. So what are you buying here? What's this extra $200,000 for? Growth potential, employee strength, training programs, quality reputation, the overall reputation of the company. So Apple has lots of goodwill. We talked about this during office hours. Apple shares sell for about $565 a share. If you wanted to buy Apple outright, you're going to pay a lot more than $565. So definitely there is an intangible. It could be location. It could be all of their retail stores. Whatever it is an intangible asset. Okay, and that's goodwill. Let's do a couple more of these. Okay, next one. Trademark should not be amortized. Okay, trademark should not be amortized over its useful life. Okay, true or false? Trademark should not be amortized over its useful life. Is that true or false? Okay. All right. Good job on that one too. Okay. Now, you don't amortize something like a trademark. You're not going to amortize the value of the Nike swoosh, as they call it, or the Apple, the logo for Apple. That is a trademark that has value and it lasts as long as the company is in business. And if you recall, we're going to go over this again at some point. But if you recall, and why isn't this working? Let me go to the doc cam again. There it is. Okay. Oh, that's right. I'm taking his. That's his foot. Okay. There we go. There you go. Thank you. All right. So, as we said on Friday at some point, intangible assets are two types. You have finite or definite life intangibles, like franchises. So you have the ability to, if you buy a franchise, you have the ability to sell McDonald's hamburgers for, a 5-year period. That is a finite life and it's subject to amortization. Indefinite life intangibles are not amortized. That includes goodwill, trademarks, trade names. They're not amortized because they are tied to the business as a whole. The Apple logo has value as long as Apple is in business. The Apple logo has value as long as the company is in business. Okay? All right, so we have two types of intangibles. Finite or definite life intangible assets where they're written off. Patents would also be amortized. Someone asked today during office hours regarding amortization. It's typically straight line amortization over the life that is designated for that particular intangible. Okay? All right, so let's go on to another one. I'm doing this as a review for the last topic that's on the final. Just want to make sure that we're comfortable with the material. Okay. All right. Now, I'm not going to ask you this one because I just gave you the answer. All right, so which of the following should be amortized? Well, the answer is C, because these are definite or finite life intangibles. B, if you look at the screen, B represents indefinite life intangibles. B represents indefinite life intangibles. These are intangibles that are tied to the business as a whole. If you're operating and you're still in business, you do not depreciate goodwill, trademarks, or trade names. But however, you would amortize goodwill, trademarks, or trade names. So B, they don't amortize. C would be subject to amortization. What's wrong with A and D? A is a natural resource. What do you call that when you depletion? And D is a tangible plant asset. You call that depreciation. All right, so again, got to watch these multiple choice questions, and the answer to that would be C. All right. Now, the next one. See if we can calculate if this is, or determine if this is the correct entry. So what happened here, and maybe you could see it better on the screen. Maybe I'll put it on the screen. Let's see if I can bring that up. So I can zoom in that a little bit better. Okay, well, I already gave you the answer, so I drink a lot, by the way. I'll go over this one with you. I'm at McGovern's before class. All right. Okay, anyway. All right, service solutions. Well, look, it's going to be worth your while. You just don't get credit for it, so I actually wouldn't be laughing. So, all right, so Service Solutions paid $200,000 to acquire Tablets, Inc., an electronic gadget advertising website. At the time of the acquisition, the balance sheet reported assets of $200,000 and liabilities of $100,000, and the fair values happen to be the same. Now, that's not always going to be the case that the fair values of the assets and liabilities will be the same as book value, but it is at this point, and I want to know if that's the correct entry. Well, of course, I know it's true because you have to figure out the goodwill, and here's the way the goodwill is calculated. So let me bring that over. The goodwill is the purchase price of $200,000 minus the fair value of the net assets acquired. And again, just to review this, because it was the last topic on Friday, the assets at fair value are $200,000. The liabilities at fair value are $100,000, so that the fair value of the assets you acquire are $100,000, and as a result, the goodwill is $200,000. The correct journal entry, of course, is here, where you debit the assets that you acquired, you debit goodwill, which gets created only in the consolidation or the purchase. So I want you to realize that goodwill, you can't create your own goodwill. So Apple understands that they're worth a lot more than $565 a share, but they can't tomorrow put goodwill on their books. Somebody has to buy them before that goodwill could be recognized. It has to be purchased. And then the liabilities are credited, and of course the cash paid for the transaction. So the purpose here was to make sure that we can calculate the goodwill. Okay? All right. And finally, let's go to the last question, and I can put this up on the screen, I think, and I'm going to answer that one for you. This is an amortization question. So you have a patent that was purchased for $200,000, and there's a couple of things, and I'm going to do this one for you because this one's a little tricky. So this one says that the patent's purchased for $200,000. The legal, that should be 20 years, by the way. That comes from the publisher. So legal protection is about 20 years on a patent, but the economic life is only 10 years. And straight line amortization is used. What's the entry for journalizing? Now, to begin with, there's a problem in that the answer that they're giving you is amortizing it over the legal life. And in this case, you should be amortizing it over the economic life. So you should be amortizing $200,000 over 10. So you amortize over the shorter of the legal or the economic life. Very simple example. You create a computer chip or a new, like, Apple has the touch recognition on the new iPhone. When they patent that, they come up with an idea of how long it's going to take Samsung or somebody else to come up with the same idea. And even though they might be protected for 20 years, they know it's going to take maybe 2 years or 3 years for someone to catch up in their next model. So they would write it off over the shorter period. So you would debit the amortization expense, and generally we credit the patent directly. So the answer to that question is going to be false for 2 reasons. One, the amortization should be $20,000. It should be $200,000 divided by 10. Right? It should be $200,000 divided by 10 years. And although it wouldn't bother me if this was a test I was grading, it normally is the case that we don't credit accumulated amortization. We credit the patent account directly. Typically, we credit the patent account directly. So the correct answer in this case should have been to debit amortization expense on the patent and that would be $200,000 for the cost. Somebody asked me today, do we use scrap values for intangibles? Probably not, because you really don't know what they're going to be worth, so there's no scrap, and you divide that by 10 years, which is the shorter of the economic life or the legal life, and then we usually credit the patent directly. That's the correct answer. So the answer to that question would be false. Oops, let me bring that in a little bit. All right. So that would be the journal entry. Those would be your debits and credits. All right, any other questions on intangibles? I just wanted to make sure we got that covered. So the exam on Friday is going to be 5, 6, we skipped 7, 8, and 9, and that's the end of Chapter 9. Any other questions on intangibles? And I've been sending out information on Blackboard. You'll get more information before the test as well, so make sure you check Blackboard. The announcements, by the way, if you're not getting Blackboard emails, let me know, because I've been sending them out and then I get people asking questions, and it leads me to believe that you may not be getting them, and every once in a while I will get a bounce back on some of the emails. So if you're not using the email on Blackboard, some of you don't have emails on Blackboard. I see it empty, or maybe it's not the right one. So make sure you have that, because I'm going to probably be able to, I will give you more information as we get closer to the exam. All right, so now this is not on the exam, doesn't mean you don't pay attention, because it'll be on an exam sooner or later. That's going to be Chapter 10. And in Chapter 10, we're now going to be discussing another asset. If you have not noticed, and I keep saying this, we go down the balance sheet. Yes, Sam, you have a question. Please hold it down, please. Could you repeat the question? Yeah, if I skip a learning objective, it's not on the exam. Any learning objectives I don't cover. Which one? If it's on, sometimes it's on the homework because I want you to have some exposure to it, but if I don't cover it in class, it's not going to be on the exam. Okay? All right. Now, as far as investments are concerned, as I said, I want you to see that we're going down the balance sheet. So we started with receivables, inventory. We did skip cash. Cash is not that interesting, I guess, unless you don't have any. But the receivables, the bad debt expense was a key area, inventory valuation, lower of cost of market. Then we looked at plant assets, intangibles, natural resources. The next asset on the list is going to be investments. So our first learning objective is to think about why companies invest in debt and equity securities, and then to determine how we classify them. The way we classify investments is going to have a lot to do with the way they are accounted. Now, when we think about, and this is something that I'm going to assume that you're not 100% comfortable with. When you invest in a debt security, what are you buying? What are you investing in? You're buying either a note payable or a bonds payable. You're buying notes and bonds, right? But now, rather than, you don't owe the money, the investor, should say, or investors are creditors. So you're actually lending money. So when you buy a bond or when you invest in a note, you're actually giving credit to a company. So we did look at Apple's balance sheet. Matt reminded me that Apple did borrow money. Nobody knows why. They went into the bond market. They issued debt. People invested in those bonds, and what's their rate of return? What's the purpose of investing in an Apple bond? Interest income, right? So the return is going to be interest. So very much like the notes that we looked at when you had a note receivable, it's kind of the same thing, except you put it in an investment account. It becomes an investment. All right, so those are debt investments. For stock investments, and we're going to go over this again in a few minutes with the slides. So you're buying shares of stock, or they're known as equity securities. Now, why would you invest in shares of stock? Well, the return that you could get, or dividends, or a gain on sale. You're hoping for a gain on the sale of the stock. So that's your return. That's one of the purposes of buying the investment. The other thing is that if you buy enough shares, what if you bought 40% of a company? Now, a lot of you may know that Chrysler Fiat is buying up Chrysler slowly, buying up shares. They started with 20% and so on. Are they controlling Chrysler's business now? Yeah, they're influencing their business. So you may want to control to obtain control of another company. So when you have stock investments, you have equity securities, and you have a rate of return, which are dividends. In fact, if you sell it at a gain, obviously, that's a good thing, and you also have the ability to control. I just also wanted to mention that when you have stock investments, I mean, you may not see yourself as an owner, but you are. All right, so when you buy shares of stock, you own part of the company. You have voting, especially if you have voting rights. Yeah.
Does the investor title change once you go over 51% of the...
Yeah, if you go over 50%, you legally own the company. And you have control over it, and you'd have to consolidate usually. You'd have to put those companies together. If you have, I mean, we're going to look at some rules in the book which are subject to interpretation when you move up into finance and accounting, but just a strict like accounting 101, if you have under 20%, you're only interested in dividends and capital gains. At about 20% or more, you're interested in controlling the company, and at 50%, over 50, you basically own it. Yeah. And we're going to show you that throughout the chapter, so it's a good question. Okay, so now let's go back and get into the chapter. So usually companies will invest, there's a couple of things, the excess cash issue. if you have excess cash laying idle in the company does the company no good. So what they're looking to do is to put that money into interest-earning assets, so bonds or notes payable you invest in, get you interest revenue, or if you buy the stock, you can get the dividends and, of course, capital gains as well. Or from a strategic investment side, you could establish a relationship that would give you control, or to actually own the company outright. You could do this by getting control of either a major supplier or a major customer. These are strategic relationships that you have. And this happened, sometimes they get too big and they become inefficient. I don't know if you know the history of General Motors, but General Motors used to buy up every component maker, so they bought AC Delco battery, Fisher body, they made the bodies for the cars, and they kept buying all of these subsidiaries to have control over all of their sources of supply, which when you do that, the problem is you don't look outside sometimes. It might be cheaper to go someplace else to get a battery than internally. I mean, you never know. You may be so inefficient that you're actually costing you more to use your own internal products. So in many cases, you'll strategically buy a supplier, maybe a major customer, some way, or a competitor to, like Sirius XM. You buy up your competition. Dish Network and DirecTV. DirecTV's been trying to buy Dish Network for years, so they have a monopoly over satellite television. So again, you might want to eliminate competition, or you may want to acquire a source of supply. Now, the big thing for us is going to be the classification. We can have a short-term, long-term classification, and again, we're not going to worry about operating cycle here because we're going to be looking, for the most part, at investments as outside of your normal operations, more likely that you're buying these investments for purposes of excess cash, and you're not really looking at this as part of your operations. But they could be short or long-term. When they're short-term, they're called marketable securities or short-term investments. Long-term investments go on the long-term asset side of the balance sheet. But the more important piece of this are the 5 classifications you see off to the right. And those classifications will result in different categories on the balance sheet as well as different accounting. So we have trading investments, held to maturity investments, available for sale, and then we start moving toward control, significant influence, and then finally a controlling interest investment. When you look at the first 3, the held to maturity and trading and available for sale, these are typically what we call passive investors. So the first 3, you're only interested in dividend income and capital gains. So if you're classifying it as trading, held to maturity, or available for sale, you're not controlling the company. You're not interested in control. Your interest lies in dividends and capital gains. When you move to number 4, you're interested in influencing behavior of that company. Fiat with the 20% of Chrysler to try to start to control the company. Maybe it's going to be a slow acquisition. Right now, BlackBerry's trying to get someone to buy them. People are backing out. But again, somebody may pick up 15 to 20%. I don't know if you know the story, but there's a financial institution, Fairfax Capital or Fairfax in Canada, that is going to buy what are known as convertible bonds, bonds that convert into stock eventually. So right now they don't control the company, but when those bonds convert, they will. So you do get not a full control, but you get influence over the company. And then, Tom, you're saying about number 5, once you go over 50%, you control the company and you will have to consolidate. So we're going to get into the details of all of those types of investments. So let's start, starting off slowly. We'll get into the actual accounting throughout the learning objectives. But trading securities. Trading securities are going to be short-term. You could be holding debt or equity securities. If you hold equity, it's going to be less than 20%, so there's no influential control here. Typically, when you have trading securities, you buy and sell them very frequently. What you're trying to do is take advantage of short-term price movement and have gains. So you're trying to buy them, quickly sell them for gains. And usually trading securities, you have to have in your organization, you're going to have an institutionalized unit that's going to do the selling and the buying if you're going to take advantage of gains on a short-term basis. So usually it's part of the company's, not normal operations, but the treasury function. Usually in the treasury department of the company, they're going to be buying and selling securities very quickly. They're not going to hold them for more than a couple of days if possible. And that would be either debt or equity securities. Held to maturity, very important. What's in red are only debt investments. Only debt securities, for the most part, have maturity dates. Equity securities, common stock and preferred stock, do not mature. Bonds have 20-year lives. Notes, 30, 60, 90 days, whatever they are. Held to maturity securities are obviously going to be debt only. They could be short or long term. And you're holding them generally to generate interest income. And the last category is right here, available for sale. These are basically the default category. It's going to be anything that's not trading, anything that's not held to maturity. Any debt or equity securities, and again, less than the 20% that you need for influential control or influence over the company. Available for sale could be short or long term, and they usually don't intend to sell them in the short run. Significant influence. I'm going to tell you that this is, just give you some terminology. When they say significant influence, this is usually known as the equity method. Oops, what happened? I hit the wrong thing? I told you I'm drunk. Okay. The equity method. Okay, so this is when you have influence over the other company, and this is when you own anywhere between 20 and 50% of the voting shares. So the equity method is where you have an influential investor, and that is known as the equity method. So the equity method is the term that we use for influential investment. And then finally, let me bring this back up on the screen. If you hold more than 50%, you have legal control over the company, and you would have to consolidate. Okay, so you'd have to use consolidation accounting. Consolidation accounting means that you add the two balance sheets together, the two income statements together. You can't, or you would not show separate company financials. If you ever looked at a set of financial statements, you will see it might tell you, Johnson & Johnson and its consolidated subsidiaries. And they do own lots of subsidiaries. Johnson & Johnson will buy, to buy competition, they may buy up a lot of their competitors making generic drugs. So, they may be buying it and getting into the generic market. Because after a certain point, the main or the brand name drugs do go generic, and Johnson & Johnson owns a lot of companies that would be selling generics. In fact, Johnson & Johnson has internally in New Brunswick a mergers and acquisitions department. That's all they do is look for companies to buy and sell off some of their subsidiaries. All right, now the last thing, I don't know if I'm going to put this up on the screen. I don't know if you could see this, but this is, let me put this up, probably easier if I put the summary up here for you. Okay, let me make this a little bit larger. And we'll go across each one. So the first one is going to be the trading securities, and this is where, again, this table is going to be important. I know there's a lot of information, but the trading securities could be both debt or equity, and these are securities, by definition, trading, where the investor holds equity securities of less than 20%, or they can hold debt, but they plan to sell the shares or the debt very quickly. And again, they're trying to take advantage of short-term price movement. Also, by way of review, held to maturity can only be debt. All right, so again, one of the things, and not on this exam, but my concern is when you're reading or doing homework or the next exam, which would be the final after this one, question about a security being held to maturity, it can only be debt. Only debt has maturity dates. And again, the investor is probably looking to hold them to maturity as a permanent source of interest income, and then available for sale. Securities would be both debt and equity. And again, here, once again, if you're holding equity securities, they would be securities that would be less than 20%, and you don't plan to sell either the equity or the debt securities in the short term. And then finally, the last two are going to be where you start to gain control of a company. Significant influence and controlling investments. There can only be equity securities because only equity securities have voting rights. So let me make this clear again. If you hold debt, the only way you can control the company is if the company goes bankrupt and you go to bankruptcy court and you have claims. But basically, a viable company is controlled if you own voting shares of stock. So it has to be equity. And significant influence is the equity method, and that is 20% or more, but really less than 51. And then over 50 is consolidation. Over 50 is going to be consolidation. All right, so those are the classifications. And again, best thing to do is you could use this diagram or use this as a guide or a summary for those securities. And we'll get back to that. We'll see that again in this chapter. All right, so now let's take some questions. Let's make sure that what we just discussed is clear, and if not, we'll go over some things. All right, so here's the first one. A preferred stock is an example of a debt security. True or false, and then we're going to explain it. I'll explain it. Okay, these should be pretty easy. They're just definitional. What do we got? Now, we mentioned preferred stock early in the semester, when we first couple of chapters. So let's see if you remember that. All right. Here we go. All right, pretty good. We have to talk about this a little bit. All right, so no, a preferred stock is equity. Like if you see the word stock, make sure you know that's an equity security. So the answer here is false, and preferred stock is equity. So how many types of equity do we have? Let's go back over some of the things we talked about when we were going through the balance sheet. Remember way back? Common stock and preferred stock. You have common and preferred. Common stock basically just gets dividends if there's anything left over. But where does preferred stock have its preference? Does anyone know? It's preferred over common, so that's number one. So preferred stock has preference over common, for sure. So that if there are any dividends paid, preferred gets dividends first. So preferred stock has priority over common stock with respect to dividends. Preferred stock generally does not vote, has no voting rights. So preferred stock is going to have preference over common as to dividends. That's its normal or its typical priority. Okay? All right. Now let's go to the next one. Then I'm going to skip that one. Okay, here we go. Let's go to the third. Companies invest in trading securities with the intent of, all right, here we go. Now these should be easy. These are short learning objectives. You only have to remember stuff for like 6 minutes or less. Do you have to pay more for them? Yeah, no. The questions come on. Let me answer that this, but I want to see 100 on this one. Oh, come on, man. Come on. All right, let's look at this. The answer is D. I mean, that's a trading security. You're trying to get profit on a quick sale. Let me move this out of the way. All right, so the first one, investments with increasing amount of long-term assets. I don't know, that one, I have no idea. Gaining controlling rights of an investee. No, you have to have the equity method there. It's got to be over 20%. Holding the investment until maturity. Well, you're not going to, that's a held to maturity security, so D is the correct answer. D is the correct answer. Okay. Let's go to, I'm going to skip the next one. Okay, by the way, that one is true. This doesn't matter. All right, here's one. Held to maturity investments applies only to debt securities. That is correct, but why? And then I'll answer your question about preferred stock in a minute. Someone had a question about preferred. Okay. It's taking forever. All right. Ah, jeez. All right. Okay. The answer is B, but it's not because they earn periodic interest. It's because they mature. I mean, look. Let me give you a hint. Held to maturity, do not mature on a specific date, you know, so, okay. Anyway, it's not because they earn interest. It's because equity, the answer really here lies in the fact that it only includes debt because equity securities would not qualify. Equity securities do not have a specific maturity date. It has nothing to do with whether or not you hold equity for a short period of time. D may not be true either, so it's got to be B in this case. Okay. All right. Let me do one more, and then we'll move ahead. Okay. Okay. Now, fill in the blank. Want to know what types of securities or equity securities where the investor owns 20% or more, but less than 50. Okay. It takes so long, you know. I think someone my age would be looking for extra time, right? Okay. There we go. All right, finally, yeah, significant influence investments. So the answer is B to that one. So those are equity method investments. Held to maturity investments can only be debt. Let me explain why why A is wrong. Held to maturity would be debt only. Debt does not have voting rights. You can't control a company. C, controlling interest, you have to have more than 50 available for sale. You have really, you're holding it and you have no intention to sell it. Again, you're a passive investor. Okay. All right, so those are the definitions of the categories. Now, how to account for these? And we're first going to look at debt investments, a very short learning objective as well. This is going to get you pretty much to cover what some of the things you may need for the exam when we talked about notes receivable and calculating interest. So it may be a good way to review that as well. So debt securities are classified, they could be classified either as trading, held to maturity, or available for sale. Now remember, you might say, well, I thought available for sale was debt only. Correct, but the other two categories could include both. Now, like any other asset, you record the debt at cost, and interest revenue will accrue. And let's remember, and I had these questions during office hours about the notes receivable also, interest will accrue with the passage of time, not on the date that you make the investment. So let's take an example, and this will be, again, something that might be useful for you for the exam on the receivable end. And we're back to Smart Touch Learning. They invest $100,000 with excess cash to buy bonds, and bonds are really a group of notes payable. Bonds are usually sold in an issue. So if when Apple went to the market to sell its bonds, it included hundreds of thousands of notes payable. Every bond is a separate notes payable, and a bond issue is really a series of promissory notes. And each one of those notes, in this case, carries a 9% interest over a 5-year life. Now, here's the thing with accrual accounting. You have to be able to split time periods. Remember the time period assumption? And just going through questions in office hours, people are having lots of problems like splitting interest between periods. So in this case, we have a 5-year life, but what's the acquisition date? The acquisition date, remember, is July 1. So the entry, when they buy the asset, is to debit the long-term investment account, and we're going to assume that it is held to maturity. That's how they classify it. That could have been classified, that debt could have been classified otherwise, except that in the problem, it tells you that they plan to hold it to maturity. So right here is where you would be forced to call this a held to maturity investment. So in this case, you debit the long-term investments held to maturity, credit cash. They also assume in this problem that interest is paid in cash every December 31st. So remember, you don't get any interest right now because the bonds were just issued at this point, and you only get interest over time. You have to hold it to earn the interest. You have to take some risk by holding the bond. Now, someone asked a question about preferred stock, whether you pay a premium for preferred, and actually preferred stock really moves like debt. It's tied to interest rates, because in preferred stock you get a fixed dividend. So preferred stock pays dividends like 5%, a fixed amount, or $3 a share. So the problem is you don't get the upside. So if Apple had preferred stock, you're stuck with maybe $3 a share, where their dividends could be $10 or $15 a share based on earnings on common stock. So common stock dividends have a lot more upside potential. So there's really no premium there. It really depends on interest rates, because preferred stock moves almost like debt. So here, for example, this debt has a 9% interest rate. In today's market, would that sell at a premium? Does anybody know? Would you pay more for that bond paying 9%? What are interest rates right now? Yeah, maybe you get a bond that pays 2%. So if that bond was hitting the market right now, it would sell for a huge premium. People would bid the price up because the interest rate is 9%. You can only get like 2.5% elsewhere. Right? And that's the same thing with preferred stock. It's got a fixed dividend. The dividend could be 3%. Depending on market rates, that's how it moves. Okay? So I just wanted to answer that question. All right. So now you bought the security on July 1. Now we have to worry about the interest. December 31st, we assume that they pay the interest. And the problem here is that interest is only accrued for 6 months. So you have to remember that the interest is accrued for 6 months. So on a timeline, you actually only held this for a half a year. So you only held the investment, or you only held the asset for a half year. So in this case, when we sort of map this out on a timeline, we're going to find out that the year end is December 31st, and they bought the bonds on July 1, and the full interest, let's say this was it 2014? This is 2014. In 2015, on July 1 would be a full year. So if they held the asset for a year, then they would get a full year's interest. So in this case, they're only holding it for 1/2 year. Now the interest on the bonds, and this is also on the PowerPoint, but the interest on the bonds for a year be 9%, that would be $9,000. But since it's only a half a year, the interest that accrues for this 6-month period is $4,500. Right? So the interest that accrues is $4,500. So you're only accruing interest for 1/2 year. And the assumption is that they pay the interest in cash at that point. Okay. So the interest would accrue for the 6-month period, or half a year. Now, the entry is going to be debit cash, because you get cash and you credit interest revenue. And that's for the half year. Okay. What would happen if interest was only paid on July 1? What would you debit here? What account? Interest receivable. All right. Here's a more realistic setting. The more realistic setting is that you're going to get interest every July 1. So that on December 31st, you have to accrue the interest. And if I didn't pay it, I would debit interest receivable there rather than cash. So if you didn't collect it in cash, you would still have to accrue the interest. Now, again, talking to some people during office hours, the argument was, or at least the confusion was, that without the cash payment, the thought or the understanding was that you wouldn't get the interest. That's not true. Even though you didn't get the cash, you still have the interest earned. That's an accrued revenue. So you'd have to debit the interest revenue, interest receivable account, and credit interest revenue. Okay. All right. So the same thing now. If you're thinking about studying, hopefully for the exam, make sure you realize that the interest has to be prorated if you have a partial period. Okay. All right. Now, what they want to do next, they call this disposal at maturity. I'm really going to say it's when the bonds mature, you're going to wind up getting back your principal and any interest that's owed. So in this problem, they're telling you that the bonds mature on June 30th of 2019. So they're fast forwarding, and they're going to turn the bonds in for the maturity value or the amount. The final interest payment, let's say, was already received. So they're assuming that the entry debiting cash and crediting interest receivable from January 1 to June 30th was already made. So you already received your interest for the period. So when you turn the bonds in, you're going to debit cash and credit the bonds payable. So that's what you would be looking at if you had the bonds maturing. Now, typically, some interest could be due at the end of the period. In this case, they assume that the interest was already collected. So they already assume that the interest entry was already made. What would that interest entry be? So anyone know, what would you do for that last period? So let's go back and think about, this is now 2019. So now we're in this part. So now instead of being 2015, they're in 2019. And the bonds mature on June 30th. So how much interest income would they record for that half year? It's still going to be the 4,500. So they assume that the entry was made where they debited cash and they credited interest revenue. And that was assumed in the problem. So they assume that in 2019, you made that entry. Debit cash and credit interest revenue. All right, so are there any questions on interest accrual on investments? Any questions on that? Okay. Now, a couple of questions at the end. I'm just going to give you the answers. These are, I think, pretty easy. This one was a bond that will mature in 2 years, and the company is going to hold them for a 2-year period. And therefore, it would be a held-to-maturity security. So the answer to this one is A. So the first one, oh, of course, again, sorry about that. Keep reminding me. Right. So again, the answer to this one is A. Basically, they're telling you here that the company plans to hold the bonds for business expansion in 2 years. So they invest, they have excess cash on a 2-year bond. They're going to hold it for 2 years. So if they're holding it to maturity, the only answer would be A. So A is a held-to-maturity bond, in this case, for $25,000. And this last one is the maturity of a bond investment, the entry, and this is what we just did. If it's a bond investment, you're going to debit cash and credit the investment account. So we just saw that entry a couple of minutes ago. So you debit cash and credit the investment account. All right. All right. So for the most part, those are the preliminaries, just some definitions. Now we're going to get into, and some review accounting of interest. Now we're going to get involved with equity securities only. We're not going to cover debt. And let's start with investments that are less than 20%. Now these are investments that do not give you any influence under that assumption that less than 20% voting power does not give you enough shares of stock to influence the decisions of the investee company. Then those securities could be trading or available for sale. They cannot be held to maturity, obviously, because there is no equity that could be or have a maturity date. Now, we're going to find out that, of course, you get dividend revenue and, of course, capital gains. But the key is that trading and available for sale can be measured at fair value. And one of the things that we said at the beginning of the semester is that there are some exceptions to historical cost, and this is one of them. So investments in trading securities or available for sale securities can be measured at fair value. The changes in fair value will be recognized as gains and losses, so that you can again, recognize any changes, and I'm going to go back to this for a second, any recognized gains and losses can be, or I should say the change is in the fair value, will be recognized as income or loss, and depending on the type of security, then we have to determine where it's going to be reported. But dividend income has to be recognized, and changes in market value, which is learning objective 4, that would have to be recognized on the financial statements as well. This is known as a change in market value is known as an unrealized gain. When you look over here, gains and losses, when you sell the asset, that's known as a realized gain. So when you have an investment that's less than 20%, you don't have any control over the other company. It's recorded at cost. It is marked to fair value. You recognize dividend revenue, and you record gains and losses on sale. That is a realized gain. Notice that changes in fair value are also recognized, and changes in fair value are known as unrealized gains. So let me try to make this clear. We're going to go back over this, but when we have securities, when we have trading, and available for sale, we could recognize them at fair value. Changes in fair value. They're known as unrealized gains and losses. But any gain or loss on disposal is known as a realized gain or loss. So this is, I think, one of the first cases where we sort of violate the historical cost concept. And remember we said we use cost because it's objective and it could be verified. In this case, let me think about these securities, trading available for sale. These are equity securities. Where do I get the fair value from? How do I know, market price. I mean, the closing price in about an hour and a half, or no, 2.5 hours, I guess the clock is wrong here. The closing price in the New York Stock Exchange is the fair value of that security. And that fair value can be used as objectively as historical cost. It is more relevant to the user, and it's just as reliable as historical cost. So it's very relevant. The fair value is much more relevant to the reader of the financial statements, and it's just as reliable as historical cost. Why is it reliable? Because 3 days from now, you could pull up the closing prices of the stock on the computer, or you can go to any financial service website, and you will find the closing price of those shares as of today's date. So therefore, using fair value here is not as radical as a departure from historical cost as one may think. It's not really a serious, in a sense, serious violation of the historical cost concept. Now, the question is, where do these unrealized gains and losses go? Do we put them on the income statement? We're going to need to talk about that. For sure, the realized gains and losses are reported on the income statement. Okay, so that's for sure. We're going to hold off here until we get into a later learning objective. That would be number 4. We'll go into that. Okay. All right, so again, any questions about the use of fair value? The fair value use here is not a significant departure from historical cost due to the fact that market prices are readily available for these securities, and it's very objectively determined. Everybody in this room can get the same price if we go on a website, get the same closing price of the stock. It's more relevant to a user, and it's just as reliable as historical cost. Okay. All right. So now, let's go to an example. And we're still looking at a company with less than 20% of the stock. So on March 1st, Smart Touch Learning acquires 1,000 shares in the Yellow Corporation for $26.16. $26.16 is the cost of those shares on the day it was purchased. And they're going to treat these as available for sale securities. The total value of the purchase, assuming no brokerage fees, and don't forget, we talk about assets being valued as the price plus reasonable and necessary expenses. Obviously, if there are brokerage fees included, they have to be added. So that includes everything. It's $26,160. So we debit the long-term investment account available for sale, and we credit the cash account. And that investment goes on the balance sheet as long or short term, depending on the company's intention or whether or not it's being used for working capital. That's available for sale. Typically, it's long-term because you don't think you're going to sell it in the short run. Now, what about dividends? let's say the dividends are paid on May 17th, and they're 16 cents per share. And don't forget, there are a couple of things in this sentence that you have to be careful to recognize. It tells you that on May 17th, the board of directors, essentially, of Yellow Corporation declares a cash dividend of 16 cents per share. That is a legal liability of the company at that point as soon as they declare it. Do companies have to declare dividends? No. In fact, most growth companies, Apple didn't pay dividends for a long time, and I guess Twitter goes public do they go public yet? It's going to be this week, I think, right? Yeah, Thursday. So once they go public, they're probably not going to pay dividends for a long time until they start to mature. As companies start to mature, they pay dividends, they start to borrow money using debt. So the board of directors has to declare the dividend. If dividends are not declared, you don't have a right to dividends. You can't generally force dividends. There are some cases, but generally you can't. They're paid to the shareholders of record on March 17th. So basically, they're going to go back and determine who held the stock as of March 17th, and the dividend will actually be paid on June 9th. So there's a date of declaration, there's a date of record, and there's a date of payment, which we'll see in much more detail when we look at the stockholders' equity section. So the dividend in this case would be 160. Don't forget, you had 1,000 shares, right? You had 1,000 shares of stock, and you paid dividends of 16 cents per share. So again, in this case, you had 1,000 shares times 16 cents. And that's your dividend, 160. Okay? And that dividend is going to be income or revenue. So the journal entry, as would be the case for any other revenue, is going to debit cash and credit dividend revenue. This is outside of operating income, but it's certainly income. Okay, so far we've looked at the purchase of an available for sale security. We've looked at the dividends. Any questions on purchasing securities or any question on the dividends? Dividends are income to the company. It's not part of operations. That's other revenue and other expenses. All right, and finally, I want to talk about those realized gains and losses. Remember, when you sell shares of stock, it's considered, or any sale, it's considered a realized gain because you realized it in cash. They sell 800 shares at a selling price of $25,000. Now, here is the most significant thing that you need to know. What did I pay for those shares? In order to figure out the gain or loss, you have to know so now you're selling, you know the selling price. Okay, so you're selling the stock for, was it 25? Right. And this is very similar to what you would do with long-term assets. If you're selling assets, it's selling price minus the carrying value. All right, in this case, cost and carrying value are the same. Now that's the number you have to come up with. And that'll give you gain or loss. If you sell it for more than its carrying value, it's a gain. You sell it for less, it's a loss. Now, that number, you have to remember you're selling 800 shares. And what was your cost per share? If you go back, your cost per share was $26.16. Okay. So you have to know your cost per share in this case. Just like inventory had a unit price, you have to know what the unit price of your shares would be. So in this case, if you sell it for 800 shares times the cost per share, it's going to be $20,928, and there's going to be a gain. The gain is going to be realized, $4,072. So there's a realized gain on the sale. Right. So we'll look at this on the slides in a second, but I just wanted to be sure that you know the cost per share. Now, in some cases, you may or may not have the cost per share. You just realize that it's not unusual to just get the total portfolio and divide it by the number of shares you have in it to get it. I mean, it's not that unusual to see that in some questions. Okay, so you're going to debit cash and you're going to credit, obviously, the investment account. And as I said, the investment account would be credited for 800 shares times 2616 or $20,928. And the credit goes to the investment account and the gain is recorded. The gain on disposal is again part of other revenue and other expenses. So I'm going to bring that up for you. And that would be the entry, the cash proceeds, and that is a realized gain on the sale. Okay, realized gain. That goes on the income statement as other revenue and other expenses. Now, the same would be, the exact same accounting would be true if this was a trading security, although you probably wouldn't be holding it for an extended period of time. All right, any questions on available for sale securities, purchase, dividends, and the disposal? All right, our last category is going to be, move that out of the way. Our last category is going to be equity investments where you hold more than 20 but less than 50. More than 20. There's still 5 minutes left according to, more than 20 but less than 50. This is where you would have what is known as an influential investment. It is due to the fact that if you own 20, 40, 45% of a company, you have the ability to influence that company's policies, its operations, its investment and financing decisions. So therefore, you're considered to be a controlling or an influential company, and we're going to use something known as the equity method. The other company, the investee company, is sometimes called an affiliate or an associate company accounting. You essentially have economic, although you don't have legal control, you have economic control over this other company. Okay. Now, 2 or 3 things that are going to make this very difficult, and I'm going to summarize this now, then I'll say a little, just remind you a little bit more about the exam. There are 2 key issues with the equity method. Dividends are not income. Dividends are not recorded as income. If you look at the second bullet, dividends reduce the investment account. Why is that the case? We'll see the theory a couple of times throughout this module or this learning objective, but you have the ability to control dividends. The dividends are not objective. You're pretty much paying yourself a dividend. If you control the other company, you tell the other company when to declare the dividend. Therefore, it's not objectively determined, and we cannot consider it income. It's also a return of your own investment in a sense, because you're really almost like one company, so that if dividends are paid, it reduces the investment account. So that's point number 1 that is critical to the equity method. The second point is that you will get a proportionate share of the subsidiary's income, or the other company, I should say, the investee income or loss will be reported on your income statement. So every year you look at the investee company and look at their net income. If you own 20% of it, you take 20% of their income to your income statement. If there's a loss, you absorb 20% of the loss, and that flows through the investment account. So the 2 points are how to handle dividends that are totally different when you have the equity method, and secondly, how to handle the income from or loss from the subsidiary. Okay, and there's a summary that you should look at carefully when you look to study for the equity method.